how is balance sheet used for strategy formulation by the businesses? And that is what all of us as valuation professionals, whether for land and building or for plant and machinery or for securities and the financial assets, we need to be aware of. So balance sheet is not merely a statement, it is much more than a statement because it helps the businesses to formulate the strategy. So how the balance sheet will help a company, a business in formulating the strategy. So let's understand, when you look at the balance sheet, what a business has to think. A business has to think, number one, redeploy maximum profit for sustainability, right? Redeploy maximum profit for sustainability. And as I said little while ago, higher the figure of reserves and surplus, stronger is the company. So more the profit the company deploys back into the business, is stronger it becomes. And when it is deploying the profits back into the company, it is creating more revenue generating capacities, which means it is also improving the future profitability. Number one, what the company also has to do, efficient management of working capital, lowering of current ratio. Please remember, as I said earlier, that current ratio is a good indicator about the balance sheet of a company, and therefore most people tend to think that current ratio must be higher of a business. Let me tell you, it's not correct. It's absolutely not correct. A business which is making profit, a business which is running its operations efficiently, a business which is making profit, obviously it would mean is paying all its obligations in time. That business can afford to have a current ratio which is lower. As a matter of fact, any business and every business, as a design, as a choice, as a strategy, must work to reduce the current ratio as much as possible. And why is that so? That is because if I am having a high current ratio, it would mean what? It means lots of my capital is locked up in inventories and receivable. That is a bad sign. So that is the number two, how the balance sheet can be used for the purpose of strategy formulation is to focus on your working capital management, and in working capital management more so on the current ratio. Number three, align the debt equity ratio to the EBITDA. As we discussed little while ago, remember we talked about the one of the indicator to judge the situation or the state of the balance sheet of a company. We discussed the debt equity ratio. Now please remember, debt equity ratio should always be looked at in conjunction with the EBITDA of a business. Meaning what? Meaning if EBITDA of a business, that is cash operating profit of a business, is sizable and growing, such a business can afford to borrow more, thereby can afford to have a high debt equity ratio. Contrary to this, if a business is having its EBITDA shrinking, this business has to be careful, and this business cannot afford to borrow more. This business will have to keep its debt equity ratio low. Number four, how the balance sheet can be used for the purpose of strategy formulation, and that is dispose of non-operating idle assets for improving break-even point. Now please remember friends, whenever we are doing the evaluation of any business, any plant and machinery, or any land and building, or any financial assets for that matter, ultimately we need to look at the company as such. And how would you be able to judge as to how is the operating risk of this business? So for judging as to what is the operating risk of this business, you look at the break-even point. If the break-even point of a business is very high, that means this business is having a very high operating risk. Contrary to this, if a business is having low break-even point, it would mean the operating risk of this business is low, and therefore a balance sheet can be used for for bringing the operating risk down of the business. How? So if a business is having a very high break-even point, what this business should do? This business should identify all the idle assets, non-operating idle assets. That means assets which are there on the balance sheet of the company, and those are non-operating. That means those assets are not being put to use and are not going to be put in foreseeable future. What this business should do, this business should dispose of those assets, and the cash that it gets in its hand should use that cash for repaying the debt. Thereby the interest cost goes down. Interest cost being the fixed cost, when it goes down, obviously the break even point of the company also lowers, and thereby the operating risk of the business also goes down. And the point number 5, as to how the balance sheet can be used for the purpose of strategy formulation, is by looking at the operating leverage. And what is the meaning of operating leverage? The meaning of operating leverage, friends, of course, is very simple. It would mean, in case if a company has a fixed cost into is in its business, a very high fixed cost in its business. Now it means what? It means this company, when the fixed cost is high, obviously the break-even point is also very high. So what this company should do is to make use of the operating leverage. Meaning what? Meaning this company should try to do everything possible under the sun so as to increase the volume. So when the volumes are increased, what happens? The only cost that changes is the variable cost. Fixed cost remains same, only variable cost changes. Thereby the total cost per unit also goes down. As a result of that, company is able to earn more profit. And this is how, by resorting to these 5 points, the business would be able to use the balance sheet for improving its performance. And what those 5 points are, just to sum it up: number 1, redeploy maximum profit for sustainability. Number 2, efficient management of working capital by lowering the current ratio. Number 3, align the debt equity ratio to the EBITDA of that business. And number 4, dispose of non-operative idle assets for improving the break-even point. And number 5, make use of operating leverage. And this is how, friends, we as the valuation professional would be able to interpret the balance sheet information, P&L information, and use the same for formulating the strategy so as to improve the financial performance of the business, and thereby improve the valuations of that business. So in case if there is any question, you can please unmute yourself and ask me, else we'll go to the next point.